Good morning. Good morning, everyone, and good afternoon, depending on from where you're joining us. Thank you all for joining us today to discuss Protocol 1 of the UN Tax Convention. And special thanks for our distinguished speakers that have joined us. Let me briefly introduce the topic before starting the discussion with the speakers. So why we are discussing Protocol 1 today? At ODI Global, we're interested in international taxation. I'm Mona Barake, I'm a researcher there, and we have been following the discussions in the last few months. So, as you know, over the past decade, international tax discussions have focused on a growing mismatch between an increasingly digital global economy and tax rules that have become outdated. As services and digital transactions expand across borders, many countries, particularly developing ones, often they have limited ability to tax income generated in their own markets. So Protocol 1 of the UN Framework Convention is an attempt to address this challenge. How did we arrive here? Of course, the emergence of Protocol 1 reflects broader developments in international tax reform. In recent years, countries have experimented with various approaches, such as the OECD Pillar 1 and digital services taxes, to address similar challenges. But with Pillar 1 stalling and unilateral measures of DSTs proliferating, the UN negotiations have opened a space for a more inclusive multilateral discussion on how taxing rights should be allocated in the modern digital economy. So we are very pleased to have with us an excellent panel of experts who have been closely following these discussions. Where are we standing now? After the February 2026 UN session in New York, it has marked an important step forward as discussions began to move from general principles toward technical design of the protocol. Several key questions are now emerging in the negotiations, such as the scope of services covered, the nexus rules that would trigger taxing rights, and the design of the tax mechanism. So whether it's gross, net taxation, and how the protocol would interact with existing tax treaties. So let me now introduce our speakers. We first have Lieselot Margareta Cana. She's the co-lead on Workstream 2, so the Protocol 1 of the UN Tax Convention. We have Faith Amaro. She's a researcher and a PhD candidate at the Institute of Advanced Legal Studies at the University of London. We have Dr. Frederick Heitemüller, researcher on tax policy at the International Tax Center for Tax and Development, ICTD, and Everline Moendo, policy lead, tax and international financial architecture, and coordinator at the African Civil Society Working Group and the UN Tax Convention. So let me first give the floor to Lieselot, and she's gonna walk us through Protocol 1. Lieselot, the floor is yours.
Thank you very much, and thank you very much for this invitation. It's really a great privilege to be able to connect with other colleagues and also with other interested parties. We are doing a difficult job, and it's really important for us to listen to as many actors in this area as possible. So thank you very much for the invitation, and thank you for giving me the possibility of acting with you. So Protocol 1, which is the Workstream 2, aims to set multilateral rules for taxing income from cross-border services in general. And of course, we have clarified already that this includes digitally delivered services. As you can imagine, these negotiations are both highly technical and highly political. And we have until now, last meeting being in February 2026 in New York, been scoping the issue, and I, with the Secretariat's help, presented an issues paper that you probably, hopefully have seen, and which was discussed at that February meeting. So after that February meeting, we are now moving to a more, of course, the interesting part and the even more difficult part of this work, moving from the options to that was presented in the paper and the issues that were presented in the paper to solve. We will now try to resolve and move towards some draft solutions in a draft treaty text. So what are we discussing? Well, of course, we're discussing the scope of the protocol. I'm not going to go into very much detail of this because I know my colleagues are going to go into details of some of those issues. So I just raise them now and we can come back to them and we can perhaps discuss a little bit more what issues are worth consideration. So, scope of the protocol, which activities or taxes are covered? Are we talking purely income taxes versus turnover, digital services taxes, withholding type measures? There seem to be convergence that we need a clearly defined scope. However, and this has been something that we just tried to have a good discussion on, there are taxes that have the same effect as income taxes, and they may need to be covered in our multilateral agreement. We're also, of course, talking nexus when the jurisdiction acquires taxing rights, and what should trigger source taxation rights for cross-border services. We have discussed options as, of course, the physical presence test, which we actually think, I don't know if most of us, but I think many at least, think is the reason we have that test is outdated, and therefore we are in the situation we are now, trying to resolve the problems we have in the digital economy. So what are the other options? Payment flows, user, market-based nexus, significant digital presence, and of course, hybrid indicators. So we need to have rules-based tests with objective indicators. That's convergence on that issue. But we may have different nexus rule for different services. And that is an issue that we need to discuss a little bit further, and be nice to hear your views on that. Developing countries and many source countries favor market, user, payment-based nexuses, while more developed countries favor treaty model nexuses, like physical presence in Article 5 of the OECD model. And also, I would like to mention I mean, there are several other issues, but for the time being, I will only mention these three issues, and that's the method of taxation, because that's something we also discussed into detail. Should we go for gross withholding, a turnover type tax versus net, a profit allocation, or inclusive, a blended attribution approach? Here we do have a general agreement that the solutions should be administratable, practical for both administrations and users. So I'll stop there and look forward to come back and make and hear questions, and also be able to make other comments on other presentations. Thank you.
Thank you, Lise, a lot for raising all these different points and giving us like a general overview of where we stand on the technical design of Protocol 1. We're gonna move to Mrs. Faith Amaro. She's gonna walk us through the scope of services and different services in Protocol 1. So Faith, the floor is yours.
Okay, thank you very much, Mona. Just confirm that you can see my slides.
Yes.
Great. Indeed, like Lisa Lot has said, it is a pleasure to join this distinguished panel for today's webinar. And thank you very much, Lisa Lot, for very ably setting the scene with a broad overview of the protocol and the key issues under consideration. What I will attempt to do is cover the nature and the classification of cross-border services, drawing on findings from a research paper that was produced at the request of the G24, and it was co-authored with the distinguished Professor Sol Picciotto. For our analysis, we use data from the OECD WTO Balanced Trading Services, as well as the OECD International Trading Services datasets. These are the only source of comprehensive bilateral data on trading services and are consistent with the IMF Extended Balance of Payments Manual. These organizations have also published a handbook on measuring digital trade in 2023. So I'll highlight some of the key findings from our research. We examined cross-border services imports, which are defined as services provided to customers in a country by a non-resident, and our methodology is detailed in the paper. But what you'll see as a starting point from the graph, the expansion of cross-border services in relation to GDP dates back to the 1980s, when digitalization began to take root. During this period, mass market software products were deployed at scale, digital intermediation platforms were pioneered, and electric mass media capabilities were expanded beyond just radio and television to include cable, satellite, broadcasting, etc. The sharp acceleration you see from the 1990s results from the explosion of the internet and the World Wide Web. This growth primarily stems from digitally deliverable services. These are defined as those which can be delivered through ICT networks. We will examine this category further on the next slide. Conversely, you will note that non-digitally deliverable services flatlined overall in relation to GDP. These relate to cross-border services provided by non-residents, but requiring some form of local presence. They include transport, construction, extractives, etc. So let's now look at the nature of digitally deliverable services. While it would naturally be assumed that these would be highly automated and requiring minimal human intervention, we see from the data, and that should be next slide. Yeah. Sorry. This is the slide. We see from the data that this growth is in fact most pronounced for other business services. This reflects the broad integration of services across the whole economy. And this transformation, in fact, has been regarded as the entire servicification of the economy. We'll look at other business services specifically, but I also want to draw your attention to two other categories here. Telecom, computer and information services, which are the second largest sector of digitally deliverable services. Their growth represents the progressive technological improvements to ICT tools and infrastructure, as well as the delivery models. You will note that financial services are the third largest, and the digitalization of the financial services sector began with advancements like the introduction of consumer debit and credit cards, and it expanded rapidly with the internet explosion. So I would like for us now to examine other business services. The largest proportion of these are business-to-business services, which increasingly became digitally deliverable from the 1970s, but are not usually automated. These include technical, managerial, research and development, consulting, professional services, etc. A smaller proportion of this sector are highly digitalized business-to-consumer services, like platform-based digital intermediation services, estimated at about 10%, as well as advertising, market research, and public opinion polling services, about 15%, which may be automated. This classification excludes other business services like agricultural, mining, operating, leasing, which require some local presence and are classified as not digitally deliverable. So how does this all fit together? Using data for the most recent year, 2023, we were able to classify cross-border services in 4 broad categories. The first, as you'll see from the graph, are those that are not digitally deliverable, i.e. they require some physical presence. We estimate that these are 30% and include international transportation, construction, manufacturing of physical inputs owned by others, waste treatment, agricultural, mining, and all those fall within that first category. The second, as you will see, relate to services that are digitally deliverable, i.e. can be delivered remotely, but require some human input. These we saw when we looked at the slide on other business services. We estimate at about 25%. They include technical, professional services, many business-to-business services that typically would fall under the scope of Article 12F, fees for technical services. The third broad category are automated digital services, i.e. can be delivered remotely, but do not require any form of human input. These fall within two broad categories, are rapidly expanding. We estimate to be 35%. The first are within the scope of DSTs, and the second are outside the scope of DSTs. Those outside the scope of DSTs include, say, financial services, insurance, pension, licenses to produce computer software, telecommunications, etc. Those within the scope of DSTs, again, a varied scope, but we estimate that they would only cover 13% of all cross-border services. These include audiovisual services like streaming, cloud computing, digital intermediation, advertising, etc. The final category are charges for the use of intellectual property rights, excluding software licenses. These we estimate at 10% of cross-border services. They would typically be categorized as royalties within tax treaties and are taxable at source. So I will close by just drawing two broad implications of the data. The first, and again, Litsalot has highlighted the inadequacy of the physical presence test for at least 70% of all services now, which can be delivered by digital means, i.e. with little or no physical presence. The PE requirement is appropriate and outdated. And even for the 30% of cross-border services that require some local presence, this may not amount to a PE. For example, physical contact may be intermittent for international shipping or air transport, or even services in sectors like construction or agriculture or mining. If they're delivered at the client's location, it may not generally amount to a PE. So while physical presence remains an important nexus for taxation, it shouldn't be an exclusive right, and the discussion really should focus on a fair and equitable solution to share these taxing rights where the activities take place in line with Article 5 of the Draft Framework Convention. The second I would like to highlight is the business-to-business services and the charges for the use of intellectual property rights collectively make up 56% of all cross-border services. These are deductible from business profits, and what that means is they effectively reduce the source tax base. Where treaties prevent source taxation in the absence of a PE, the source country loses both withholding tax revenue as well as part of its corporate income tax base. And this base erosion dimension is central really to the policy concerns that we are dealing with. So a lot more can be said on cross-border services, but I'll finish here, and thank you for your kind attention.
Thank you, Faith, for the presentation and for taking us through the different categories of the cross-border services and the level of digitalization as well of them. We're going to move to Dr. Frederick Heitzemuller. He's a researcher at the ICTD, and he's going to walk us through the implications for the international tax treaties and the risks of double taxation. So the floor is yours, Frederick.
Thank you very much, Mona, and thanks to everybody else for being here and discussing these issues. As you mentioned already, I would like to briefly talk about two issues in relation to the protocol. So the first I'm going to talk about is that what will be important when looking at the method of taxation is getting to a solution that strikes the balance between administrability and economic efficiency or fairness, and that distributes taxing rights in a fair manner, without at the same time implementing a tax that ultimately will only be borne by the local customers that import services. So it will be important getting getting the incidence right. And doing that in practice is not easy, I think, and requires also to disregard labels of taxes. Especially in the international context, the incidence doesn't really depend, I think, whether you call it an income tax, a withholding tax, turnover tax, DST, or sometimes maybe even value-added tax. Rather, it depends on how well it actually captures net profits of a company and what is the combined tax burden of taxation in the importing country and in the exporting country. So there, as has been, I think, said often, is that using a gross solution only without net option can risk taxation that exceeds the profitability of a transaction, depending, of course, on factors of the firm, the composition of the market, etc. But so it is a possibility, and might mean that any tax could be passed on to the local clients. But it's important to highlight that it not only depends on of course, a tax levied by the importing country, but also by taxes or by the tax rules of exporting countries, in particular provisions for relief from double taxation. And with respect to the latter point, there's currently a lot of diversity with respect to what kind of relief is actually granted unilaterally and under treaties, and how that is calculated in practice. For instance, if you can carry forward excess credits, what kind of costs you need to take into account when calculating a credit limit, etc. And so these issues all affect kind of the equation. Another important thing to highlight with respect to that, I think, is that we should not evaluate any solution in a vacuum, but rather based on how it changes the status quo. And depending on the countries involved, of course, in some bilateral relations, importing countries can currently levy income taxes, and others they cannot because the treaty is preventing that. And in some, the exporting countries might grant relief, and the others not. So in some, there might currently actually be a double taxation or perhaps excessive taxation, and there one can also see the protocol as a chance to alleviate this and even reduce the tax burden for certain transactions. So the second issue I would like to briefly talk about is the interaction of the protocol with tax treaties. And I noted that at the session in February, this appeared to be one of the most controversial points, with some countries calling for a solution that overrides treaties, others calling for a solution that would only implement it through bilateral renegotiations of treaties. I think it may be a bit complex to evaluate what would technically be better, but politically, I think the trade-offs are very clear. The advantage of doing it bilaterally is that you can make it, of course, easier for countries to sign on, and you kind of take out a little bit of the political tension that might be there. But or you can another point is, I think, that you can address situations, for example, more easily where countries have reciprocal flows and they might not really care so much about the level of source taxation, or perhaps because they've already negotiated a good level of source taxation in their treaties. But I think ultimately the problem is, or the issue is, how do we avoid a solution where one party refuses to amend the treaty with another party who is actually dissatisfied with the treaty. And so I think leaving the choice of which treaties to modify completely open might mean that this protocol, or might risk that this protocol doesn't do much more than what the UN Committee of Experts already did by providing model solutions, let's say, such as Article 12A, Article 12B, that countries then are free to leave or adopt. So ultimately, yeah, in order to avoid that risk, the discussion should at least, I think, attempt to the more multilateral way, whether that is then in the end a multilateral treaty that overrides treaties or some kind of minimum standards for existing treaties that needs to be implemented, and countries cannot refuse. That I think could be different ways to explore, but yeah, in the end, yeah, it will be important to address that point. I'll stop here for now and happy to talk more later.
Thank you very much, Frederick, for taking us through the different aspects of the tax treaties and these challenges. We're gonna move to Everline Moendo. So she's gonna highlight the perspective of developing countries and why Protocol 1 could be a very important proposal. So Everline, the floor is yours.
Thank you so much, Mona. So on the considerations of developing countries, particularly on the methodology, sorry, just give me 1 minute. My sincerest apologies for that. I needed to handle the noise levels. So I hope you can hear me clearly now. On the considerations of developing countries, and I think I should be more clear, global South countries, on the specific methods of taxation. I think first and foremost, we have to remember that this process began due to the dissatisfaction, particularly of African countries, with the manner in which international tax proposals did not take into consideration their capacities and their priorities. So the solution that we're looking out for is a solution that should be administrable by the least capacitated amongst us. And that's, I can deduce, one of the positions of developing countries. So for that reason, obviously, gross taxation is going to be what the methodology that is most favored by African countries as well as other global South countries because of the ease of administrability. But then there's also the risk of under-taxation, as has been discussed. There's also the risk that sometimes the costs of these taxes can be easily passed over to the use of the services. And perhaps one of the most difficult conversations I remember we had during the February negotiations is what happens in the case of non-payments. So if you have a company that extracts data from, let's say, Kenya, and then sells the data elsewhere, the payment has happened in another country, how can Kenya essentially benefit from the value that has been created by the user data of African countries or of global South countries? So that's a big challenge, and I know the conversations on that are still happening. And maybe perhaps to touch on the nexus issues, I know we're definitely going to have more conversations on significant economic presence and the use of both digital factors as well as revenue factors. But then I also want to highlight that the biggest barrier towards successful taxation of cross-border services, especially as highlighted by Faith, the digitally deliverable ones, and particularly in cases of non-payments, is the lack of information. If you look at most African countries, most of them have not implemented country by country reporting. Very few of them, I think around 5, are benefiting from automatic exchange of information. And lastly, many of them don't have adequate exchange of information frameworks. And if they do, then for many reasons, they don't benefit from reciprocity because of data safeguards and the lack of appropriate measures. So there's a whole list of issues with regard to many source countries, particularly low-income countries. I'm purposefully avoiding using the word developing so that China isn't considered to be a developing country. So you can see there are a lot of barriers towards access to information, which will be necessary in order to effectively tax non-resident taxpayers. So I think as we have discussions on Workstream 2, it's also quite important for us to discuss, especially within the context of need-based taxation, the mechanisms or the things that we will have to do in order to make it more effective than it was, which is, of course, access to information. And I know, for instance, we also had conversations on the issue of the transfer pricing database, particularly when we're discussing Workstream 3. And you could already see that even for countries that are a little bit better than, let's say, tax administrations of low-income countries that have transfer pricing units, it's still quite difficult to invest in access to those databases. And even if you can access them, sometimes the data that you get does not reflect similar market conditions to what happens, particularly within the Global South. So there are a list of challenges, but these are conversations that we must have during discussions in Workstream 2 to really come up with a solution that is easy to administer and actually beneficial for the least capacitated amongst us. Thanks, Mona.
Thank you, Everline, for raising the different points and challenges, especially for low-income countries. So based on what Everline just raised, and so we're going to continue now the discussion after taking the statements from the speakers into a more roundtable format. So I'm going to start with some questions for the speakers. And so the first question is going to be a highlight from what Everline just mentioned. So there are many challenges related to the categorization of services, for example, in the case of non-payments, and challenges around nexus. So maybe we can start with either Lieselot or Faith, if you have any comments on, or if you'd like to raise something around these questions.
I can start if you want. I think, that some of the issues that, there's so many aspects or inlays in this, which makes it, of course, difficult. But one tried to keep things in our mind, and I think one of the things that one could keep in mind is that many low income countries actually don't have a tax treaty network. So that is a group that it's actually quite free to do a lot of things. They can, they don't need to override bilateral treaties. They can actually do this multilateral agreement and actually, make perhaps some of the, policy decisions directly in a multilateral treaty, which is negotiated. Of course, when it's multilateral, it is, it is somewhat balanced, more balanced, I should perhaps say, between a smaller and a bigger economy, etc. So it might be very good for that group of countries. But we also have a group of countries that are have bilateral treaties, and what they have bilateral treaties, even if they have a small network, they have a bilateral treaty with their major trading partners or major investment parties. So, that needs then to be addressed, the idea of, is this multilateral agreement going to help them? Because what we've heard from that group is that they don't feel the possibility policy-wise in their country to denounce treaties, because that's of course what you can do. If you're not happy with what you have in your treaty, you could denounce it. Now, I would say if we have a treaty, multilateral treaty, that actually covers quite of the few things that you have in a bilateral treaty, perhaps it will be easier to denounce the bilateral treaty, because from a policy perspective, the country can say, look, I prefer this multilateral deal than my bilateral treaty, but there is a deal. We're not going to, not having a deal between ourselves. There is this possibility. Sign up to this, which we think is more modern and, and give us the right outcome. And therefore I could, denounce my bilateral treaty, or the multilateral treaty can override my bilateral treaty. And that will depend, of course, on what the multilateral treaty itself says. Now, I think those aspects are interesting if we're going to be able, what I'm trying to say is that it's not easy to sort of be able to deal with all those points in one multilateral agreement. But I think, we have to have the ambition to do that. And I'll stop there to hear if there is any other comments on that.
Thank you. Maybe, I don't know if some of the other speakers would like to jump on this or have comments related to this point.
Yes, no, I completely agree with Liselott in terms of her submission in dealing with it. I also see the design of the protocol being a separate question from revision of existing treaties, and the protocol design really being focused on having a form of common rules that can then be implemented, even in its design, building on coordinated approaches, for example, like the global minimum tax under Pillar 2, that would work, as opposed to, the strict binding agreement that would require a certain number of countries, etc. Thinking about the actual existing treaties, perhaps the revisions could be done under an MLI or even an instrument like the UN Fast Track instrument to speed up adoption in that regard. But I think the design of the protocol and its implementation and model would be looked at least in my mind, in parallel from that of the question of revising existing treaties.
Thank you, Faith. If there are no other comments regarding this specific, yes, Everline, go ahead, please.
Yes, I just wanted to point out, despite a wide treaty network, I think lower income countries are still the victims of base eroding payments, which often involve payments of services, payments of interest. And so I also wanted to highlight one of the concerns of civil society is also the lack of attention, particularly on intergroup services, despite the data that Faith has shown us that a lot of these payments for services is actually delivered amongst multinational corporations. So these are related transactions. So I think it's also important to look at the harmful tax practices in relation to Protocol 2 and not Protocol 2, sorry, Protocol 1, and also some of the actions that we can take not only to protect source taxing rights, but also to prevent the base erosion that happens because of such payments.
Yes, Liselott. please.
Yeah, no, thank you, Evelyn, for raising that, because that is actually one of the points that I thought perhaps it'd be interesting to mention. There are a couple of studies out there now. I don't know if you've seen the ICC study, you have seen the IMF study on services. And I think there is a point there where the ICC paper, first of all, say, if you use 12AA, you will reduce trade and investment, basically. And I think, first of all, that is a statement which is wrong, because depends on your domestic situation before you sign a tax treaty. If you have a tax treaty that you have higher tax rates than you would negotiate in a tax treaty with 12AA, then you will increase trade and investment. That's just the conclusion that the ICC paper very simplistically would come to if it said it. It doesn't, but that's the reasoning behind it, the paper. Now, in conjunction with that, what I would like to mention is the IMF paper, because the IMF paper says also that trade and investment might be reduced if you have a tax withholding rate on cross-border services. Now, what the IMF says with that is that perhaps that's a good idea, because there is BEPS-related payments, and that's a little bit what Evelyn was aiming for with the intra-group services comment, the related parties that we have. And I think this is something that we haven't talked about enough, but I do think that we should include it in our discussions, because I think it is one of the if we reduce that, which IMF says that we might if we have a tax withholding rate on services, but the IMF says that might be a good thing. Then and that if there could be more studies on it, but intuitively I think that is probably correct, and that is the reduction in base erosion that we need. So there's another positive thing with having a gross withholding on tax on cross-border services, which I think we haven't talked enough about. But I think involving the related party aspect of this is very important. So I just wanted to add that to when Evelyn raised the issue. Thank you.
Thank you, Liselott, for raising this point. Yeah, that's true that the IMF paper actually highlights that there's an effect of maybe like withholding taxes and this relation with reducing profit shifting. So it's, of course, there should be more studies highlighting this, that it might not be harmful for actually the trade of services, but it can lead to a reduction in profit shifting, or at least the part of services that are being used for profit shifting. And related to that, so some countries are obviously, as we've mentioned, leaning towards gross taxation, some others toward net taxation in Protocol 1. So we might end up seeing a mix of both. How realistic this could be? Of course, if we have only like one system, whether it's only gross or net, it looks more straightforward. But if we end up in this mixed solution, how do you see it in practice, like the feasibility of it? It's an open question for any of the speakers if you'd like to jump on it. Yes, Frederick, please.
Yeah, just maybe a few thoughts on that. I think if like a net option is included, I think how to administer it still would depend then on how that net solution exactly looks like. I think there are options that look would look perhaps at the net only of specific transactions. So basically, you have a certain transaction, and then when calculating how much tax is owed on that in a source country, you take into account certain costs that that company had. I think that's maybe politically the kind of easier thing to get to, but probably quite complex to administer, or would require exchange of information in any case, or like a functioning exchange of information, let's say, which for some tax administrations might be no problem at all, but for many, at least still currently it is, I think. And the other way I think of doing net, perhaps there are more that I don't have in my mind, would be curious to hear from others as well, is of course like more of a formulary solution where you take part of the global profits of a company and then apportion it like Pillar 1 Amount A was doing, which I think requires probably more cooperation or coordination upfront, but then is perhaps less intensive in checking the individual facts, or at least not every country might need to do it. So I think there are certain trade-offs in that.
Thank you, Frederick. Faith?
Frederick has highlighted similar thoughts that I had to this particular question. Okay. Perhaps just to add, and again, to Evelyn's point around the dearth of information by countries, a simplified way might be adopting, again, a form of apportionment method using information already available to the tax authorities, and then applying the MNE's global profit rate to the local share of revenue. And, when I think about that, what comes to mind is something similar to Article 12B with the 30%, or even India's proposal 2019, the 3-factor formula, 1/3 to sales and 2/3 to the supply side, manpower and assets. But also they could alternatively be a deemed profit, similar to, and I think it was a proposal India made last year in October, where they looked at different industries and, attributed a particular profit rate, with some being much higher than others. And that could be rebuttable if, say, the multinational provides then appropriate data, but undoubtedly complexity, because it would require a lot of coordination, but that might be a way to start.
Thank you, Faith. Lieselot, please.
Yeah, I gross withholding in the end of the day is a estimation of what is a net taxation. In the end of the day, it depends on your corporate tax rate. If you have, say, a 30% corporate tax rate, you have a 5% gross withholding, it's a relation. It just takes account of a certain amount of, costs, and therefore it's 5%. So that calculation is could be done. But I think the point is what as a system, what one can do. There are different margins in different businesses, and perhaps one can try and be flexible. So like say my corporate rate is 25%, and I should apply a profit margin in this area with so and so much, and that then would reduce and apply to my withholding rate that I would have in my country. I don't know if I'm explaining myself very well, but I hope you understand what I'm saying. And then what I also think is possible, you can apply that. That could be the sort of the base rule. However, if the taxpayer wants to provide with a full tax return and being under, the system of that country, he can also do that. I mean, there's nothing wrong with having a representative in that country. It's basically a PE. Not very far from it, at least from the way we understand a PE. And you know, that person or that could then present a full tax return with, you know, with all the costs assigned, etc., and be subject to the normal sovereign rules of that country. So I think, to me, the gross and net is a discussion that I think has been absolutely overstated. And from my perspective, in my country, we always see that the taxpayer has a possibility of being net taxed, even though we have gross withholding on everything in our domestic law. If that person thinks that they want to be a resident of Chile, resident being a PE, not technically a resident, but subject to our filing rules, administrative rules on filing a tax return. It can always do it. It's not, no one stops you from that. So, you know, I've always thought that this idea about net and gross, I really don't understand it until, and you might know more than I do, but until I understood some countries actually don't have the possibility to tax unless there is a PE, and it will always be on that taxation. Then I started to understand the discussion on it. But for most developing countries, I don't think there is an issue. Thank you.
Thank you, Everline.
Yes, I think as civil society, our proposal has always been unitary taxation and formulary apportionment, to also answer the questions in the chat. But then, as experienced in Pillar 1 Amount A, that would require a high level of cooperation, particularly from the least cooperative, which is the US. So as civil society, we are also advocating for the simplified approach that I think Faith was talking about, which is also unitary taxation and fractional apportionment. But also just on the issue that Liselott has pointed out, I think this is why many global South countries are really stuck on the issue of nexus. And particularly for Kenya, there's been quite a number of cases. There was the Kenya-France double taxation agreement, which didn't allow Kenya to impose withholding taxes on what they thought was technical fees, simply because there wasn't a permanent establishment. So this is definitely something that we have to go back to. I do agree to a certain extent that we can't really fully address the issue of the method of taxation if we haven't fully addressed the issue of nexus. I think those two conversations they feed into each other. But yes, just my comments and also to address some of the questions. I mean, there've been conversations about how to treat non-cooperative jurisdictions, such as the US. And and this also goes to the question of how, you know, the framework convention as well as the protocols will be enforced. There've been suggestions of imposing retaliatory taxes on non-cooperative jurisdictions such as the US. The political feasibility of this is questionable, but then eventually, you know, if a good number of countries take a unified and harmonized approach on this issue, then perhaps there will be adequate political pressure also on non-cooperative jurisdictions such as the US to participate at some level. You know, in Kenya, we've had a big issue with unilateral measures such as digital services taxes. I know that the Kenyan Tax Administration even had to transform or do away with DSTs and introduce significant economic presence. So really, we really do need to also discuss what happens with non-cooperative jurisdictions, and then also what happens when they do decide to take retaliatory measures, either through trade or through the big beautiful bill. Yeah, those are also discussions that are necessary. And perhaps what are the actions we can take as Global South countries when such things happen?
Thank you, Everlyn. So there are so many aspects that we can go on to discuss about. I think we still have time for one question before opening the floor for questions from the audience. And I see that there are already some questions in the chat. And Everlyn, I think you responded to one of them indirectly or directly in your last response. So maybe the last question that we can take is either so since we were discussing, gross basis versus net, and whether this is, how relevant is it? Because as Liselott mentioned, it depends on the rate and profit margin, etc. So it can be one equivalent to the other, depending on, of course, the design of each. Do you see Protocol 1 as having a coordinated tax rate, of course, for maybe different services? How do you see this, especially that we have very different services like ADS, the automated digital services? Will we might have DSTs in parallel with Protocol 1, or even countries that wants to introduce Protocol 1 would like to also keep the DST, or introduce, merge these two together somehow? So maybe this is a last question that we can discuss briefly with the different speakers. We're going to start with Liselott.
Okay, thank you. Now, I think I think it's a little bit of what I said before of targeting different groups and being able to reach and give each little group what they need. And I think, well, some groups are larger than others, but I do think there's a large group that needs to validate their DSTs. Basically, we do not want a war on if DSTs are income taxes or not. And I think that we should leave that discussion, and we should try to cover DSTs in our multilateral agreement. This is my view, and we should be able to help those countries that have DSTs or those who want to introduce it. So we can sort of set an international standard on what are acceptable DSTs. And that would be, I think, very much appreciated with many, many countries. So, I don't see that as something that anyone dislikes. I think there are different levels of how much countries like it, but I do think it's something that a big part of the group would actually like to have us deal with. Thank you.
Thank you, Faith.
Thank you. And maybe just to build on where Liselott has left off from on DSTs, again, it makes sense, the revenue you have now vis-a-vis what you can get tomorrow. Looking at the data, though, they are only a narrow scope of all cross-border services, estimated at, say, 13%. So from an effectiveness perspective, perhaps a broader protocol solution would be better, and that effectively would enable DSTs to be phased out. But it also takes into account the heterogeneity of services and the fact that even in terms of their classification, it's difficult to box them because, some are bundled up. And so looking at a broad protocol would hopefully cover the bulk of the cross-border services. In terms of your question that you raised, Mona, specific to agreed limits, they would undoubtedly provide some form of certainty and even simplicity in administration, but I would envisage problems because of classification and also the disparity in the marginal profitability across services. Think about automated digital services, contrast that to the more labor-intensive ones like engineering or consultancy. And because of that, perhaps then the question should be around a compromise. We have already spoken about, withholding tax on a gross basis with a net option. But I think countries like Nigeria also have an interesting one where there is a specified percentage of gross income that is the minimum payable, and it's either withholding tax or 4% of net income in that regard. So compromises are possible, and I think we need to look at it holistically.
Frederick, please. Thank you.
Yes, so on the issue of the DSTs, like I followed the discussion, which was quite difficult, I think, at the last session around what should be the taxes covered and where can we draw the line between income taxes and other taxes, or between perhaps DSTs and other turnover taxes. And so I'm not sure if the protocol would actually need to go there, but if it provides basically a solution that can be applied to the kind of services that are in scope of DSTs today. So, for example, if it allows taxation based on users, and also provides for double taxation relief for that, which is not necessarily the case for the DSTs that are in place today. I think then the countries might, based on if they are satisfied with that solution, they might continue applying the DSTs, or they might just decide that what they have solves the problem and abolish these DSTs on their own. I think many might not want to abolish it if the US doesn't join the protocol in the end, which is an issue. And but then so basically, I'm not sure if the discussion really needs to go there. If the problem gets solved, countries might decide that based on what Faith said, on the kind of revenue that they're earning right now, that it's not necessarily worthwhile while keeping them. So yeah, just as a quick thought on that.
Thank you, Frederick. Everline?
I'll try to be brief. Looking at the manner in which and the motivation behind digital services taxes, it was just supposed to be a short-term measure because most tax administrations had zero information on many of these corporations that had zero physical presence in African countries. So I see a situation where, similar to Kenya, if we're talking about domestic tax measures, many countries that were imposing digital services taxes will transition towards some form of significant economic presence. And some may argue that SEP is just another version of DST. But it was just supposed to be a short-term measure, similar to India's introduction of the equalization levy. And so I do think we will reach a point where we will have to transition to something a little bit more than digital services taxes for most countries.
Thank you, Everline. Lieselot?
Yeah, and I was just wondering, I've struggled to see the difference between an income tax for technical services and a DST, technically. I struggle. Fredrik seems to, saying that, it's people or countries would like just to keep them. But the point is, if you're in the long term, if you're going to keep DSTs, I mean, to be honest, why don't we do all that then and forget about, we do services in general? Why do we talk about digital? If a digital service tax is a turnover tax and it's not covered by tax treaties, why don't we forget about all this and do all, and instead of digital service tax, we just talk about STs. And, we tax with 2% and we forget about the discussions. Because to be honest, I mean, I had this conversation with someone from a Canadian tax professor, and I asked that professor why the Canadian DST was not an income tax, and he said, "Well, it's a gross withholding." Well, we can do all gross withholdings, and then we don't have any income taxes anymore. It seems to me that that discussion is a dead end. And if we're going to say, we just keep DSTs and forget about the discussions, then we are actually going to undermine all our efforts of avoiding double taxation. Because in the end of the day, DSTs, and I think why perhaps some members, some countries' administrations don't like them, is because they do give you double taxation. And if you do include them in a multilateral, the counterparts would have to give a credit for it. Or that we can discuss as well. I think that's part of the discussion. We could just keep it. This is our general way that we allow cross-border services to be taxed in the source country where the payment comes from. And, sovereign, I override my tax treaties, or I just skip my tax treaties and I do diverted profits tax sort of design, and then I override it anyway. I think we need to be serious, and I think we should, talk about things in a serious way and try to keep our international agreements as pacta sunt servanda. I agree. I went into something and I should comply with it, and I have the feeling that we're going in a way which is, the strong big countries do what they want to, and the small developing, including my country, we have to try and follow the rules, but, then some other ones have a diverted profits tax or a DST or whatever, and see, it could be an ST in the future, and we are really in a quagmire. Sorry, I got a bit emotional there.
Thank you. Thank you for providing a very honest and clear, transparent opinion. So I think we're gonna I'm gonna start with the questions, and I'm gonna look at because we have several questions from the audience, so it's nice to give them the opportunity to ask their questions. So I think, Everline, you indirectly answered one of them, the one of, for example, David Phillips is asking, because the US, it's the largest service provider, and they are unlikely to sign up to the rules. So would all of these efforts be, somehow unnecessary? I'm going to read some of the questions, and then please, for the speakers, feel free to respond to them. Maria Rambalsera, for example, is asking on the why the unitary taxation with formulaic approach lack popularity among negotiators, and when it seems to be one of the best approaches to tax the digital economy. We have also a question or proposal from Professor Miranda Stewart on the gross withholding with an elective taxable presence. So it does not require a PE or an old system that requires physical presence. So it would avoid the PE debate altogether. and it really becomes a debate about attributable profit and net taxable share. Yes, and then we have a question from Florencia Lorenzo about the intragroup services. I think she's wondering about whether, the dispute about where value is being created in the case of intergroup services. And then we have as well, so we have so many questions. I don't know if some of the questions I've read so far caught your attention, or anyone would like to respond with a quick answer. Yes, Everline.
I think I already sort of answered it, but we truly live in unprecedented geopolitical times. Multilateralism, not even in tax, but in other, more crucial areas, so to speak, such as health, humanitarian laws, etc., are being done away with. Alluding to what Liselott is saying, that the bigger economies are pretty much doing what they want. So it's a challenging time for any small country that is trade partners with any of these countries to take a strong stance on particularly tax issues. But I think that's the opportunity that the Framework Convention and this protocol provides us. If at the very least, and I think I'm borrowing words, if we, from Emmanuel Eze, if we create a coalition of the willing through this Framework Convention and through the protocols, perhaps that will be adequate pressure to make the bigger economies, particularly the US, find ways to fit into what has already been publicly agreed upon. Because, we learned lessons with Amount A, the MLC Amount A. When one country pretty much has veto, then it just dumps the efforts that have been made for decades on coming up with a proper international tax proposal. So in short, I'm saying, and maybe I'll get my country in the travel ban list, but maybe we need to divide the cake amongst ourselves so that we can sort of force the bigger player to share willingly. That's what I'm trying to say. So I hope that answers all the questions within the chat box with regard to the issue of non-cooperative jurisdictions.
Thank you, Everline. I'm gonna move to Frederick and then Faith.
Yeah, on the US point, I think it's not really. If one waited for the US for everything, then probably one wouldn't have any discussion in many areas anymore. And of course, the scope of what the protocol covers is likely significantly reduced because of that. But I'm not sure if the US would never sign up to it in the future, especially since I'm not sure that the protocols should necessarily be seen as something that will things make for businesses more expensive. It can be, but it doesn't have to be, I think. It can also provide harmonization or greater certainty, so it might not necessarily be unattractive in the future, but depending on the content, of course. And then I just wanted to pick up the point raised by Miranda on an elective net taxable presence. Yeah, I think how you describe it, that would be the ideal way to do it. I don't think that it would be practical that if the intention is to provide both a gross and net option, that the net option is only available if there is a significant physical presence, then that would probably mean a practical burden to effectively enjoy net taxation if that was available. So it probably would have to be done in a way, as Miranda describes it, where net taxation is possible without physical presence.
Faith, and then Lieselot.
Okay, thank you. I will not comment on the US point. I think it has been addressed, but just a question on unitary taxation and the challenges with adoption. And again, it has been highlighted, the theme around divergent political interests and perspectives. And, you know, for the unitary taxation to work, it would require coordination. It is a challenge, but for sure, it would be the best approach. It would need a form of apportionment methodology because of the mismatches between revenue and costs. And that will require sharing of taxing rights. And I think that builds onto the spirit really of the Framework Convention and Article 5, fairly allocating taxing rights where value is created, markets are located, revenues are generated, and economic activities take place. And thinking about those not just as exclusive rights, but a multilateral way to adequately, correctly share these rights. On the question Miranda highlighted, and again, building onto Frederick's comment, I think the other way would be around a high withholding tax cap being an incentive to elect the net basis taxation as an option, even when we are thinking about the design for the simplified net income approach.
Thank you, Faith. Lieselot.
Thank you. Starting off with perhaps the question on why, if the OECD countries don't sign up to the convention and protocols, I think my point there is that if we do a multilateral agreement, which is attractive in the sense that a majority of countries in the world signs up to it, it might be easy for countries who are stuck with bilateral treaties to be able to to resign to those treaties, and therefore, if countries have domestic tax rates that are higher than the multilateral agreement, everyone would be in interest of signing up to the multilateral agreement. So, if I could perhaps say it a little bit easier, that the countries who do not have tax treaties, they should, of course, have domestic withholding rates that enable them to tax whatever flies out of their country. That's what we have in Chile. We have an omnibus article which says anything that's paid from Chile, unless it's any other article, it's taxed with 30%. So people try really to be in other articles, obviously. Yeah, so there's an omnibus domestic tax withholding on anything that's paid from Chile. And therefore, what I'm saying is that the multilateral agreement will therefore benefit anyone, because that will reduce that domestic tax rate we have if we didn't have a tax treaty. If we have a tax treaty where we had already reduced the domestic tax withholding rates that we have, and that rate is, or we have eliminated the right to tax in our country, because that, I think, is a large group of developing countries as well that has that problem, then the multilateral could be an incentive in order to say, look, we are going to denounce the tax treaty unless you sign up to the, you can now sign up to the multilateral treaty. So it's like an incentive that there exists now, a multilateral agreement, so that you can decide. So in both those cases, where you have a bilateral treaty or not have a treaty, you'll be actually positively affected by having a reduced tax burden in the source country. That's what I think could happen with OECD countries who do not sign up, or wouldn't, like, the question if they would sign up. I think they would be interested in that case. Now, on the other case of Miranda that Frederick and Faith mentioned, that's the suggestion that I have proposed in the meetings, and I think you can call it, I think Miranda calls it net taxable presence. You can actually call it a PE. It all depends on what you call it. You can call whatever. But the thing is, you opt for having something in your country that will be responsible for producing a tax return. And that, I think, exists now in any country who has a tax treaty, because if you have a dependent agent, you have a PE in that country and you can be tax net. So there is nothing new. In fact, there's nothing new with this idea. It's just that you have the option of doing it or not. And that's the only thing that's new in my point of view. And I think if you have a gross withhold with their option for a net, you can write it in this protocol and do it, but you also already have it if you have a bilateral tax treaty, in my view. Thank you.
Thank you, Liselott. I'm really appreciating all of this discussion. It's very interesting, and there are so many different points on the design of Protocol 1 that are, very important in advancing let's say, advancing this protocol into reality a bit by bit. I don't know if any of the speakers have any final thoughts to share before we close, because we still have only a few minutes. So maybe like a few final thoughts on Protocol 1 from each speaker very briefly, and then we can close the webinar. We can start with,
we can start with me. I'm going to be very short. I've already little bit let loose my frustration over how the international tax arena is developing. And I just hope that we, in a multilateral way, can actually reach something that could be beneficial and useful, and where countries actually can comply with their obligations that they have under our international rules today. So thank you.
Thank you. Everaldine.
Yeah, I also wanted to briefly try and answer Florencia's question. If I'm not wrong, Florencia is talking about the issue of application of value creation, concept of value creation within the context of transfer pricing. I think it has been a challenge because, to a certain extent, value creation can be defined subjectively. It means different things. And I think this is also the debate that was had during discussions on Article 5 in the Workstream 1 conversations on what is valuable, what is value creation? Is it the supply side factors, or is it the demand side factors? And I think in totality, this just makes a case even more so for some form of apportionment, whether it be fractional or formulary. And because I can't, Florencia, give solutions on how it's defined, I think it just shows the issues with the arm's length principle, and perhaps how we should move away from the arm's length principle and go towards some form of apportionment, whether it's fractional or formulary. In terms of my final words, I do agree with Liselott. I really hope that this can be a truly multilateral process that is inclusive, that perhaps for the first time within the international tax arena, we can really come up with solutions that are suitable for the global south and that actually lead to proper revenue gain and exercising tax sovereignty in an effective manner for countries that need it the most, which are, of course, lower income countries. So I'm really hoping that we can do that. I also want to appreciate you, Mona and ODI. I think this is the first of many conversations. We really haven't finished having this conversation. And I encourage that we keep having these sessions so that Lieselot can blow some steam. It's not easy being a co-lead of such a work stream. So thank you very much for hosting this space.
Thank you, Everline. We're gonna go with Faith and then end with Frederick.
Thank you. And again, just to reiterate the sentiments that have been highlighted in terms of the relevance of having these conversations that are timely and are meaningful, even as we chat and design the way forward. My parting shot really is just to pause and think reflectively, and the discussion is part of it on how to fairly allocate taxing rights. And digitalization, globalization just highlights how outdated the current rules are and the need for us to have rules that correctly share these rights across sets where value is created. And I think in terms of that, even just thinking through and building on two technical frameworks that are in place. And when I think about the technical work in the Multilateral Convention for Mount A and the attribution of sales revenue, they are building on from work like that in order then to design a simplified, as a compromise, a starting point, a simplified form of apportionment with withholding tax on gross payments, and perhaps move forward then from that point to complete unilateral apportionment.
Thank you, Faith. Frederick?
Yeah, maybe to start with, also thanking you for hosting this conversation. It was really great to be part of it, and I definitely learned, got a few new thoughts out of it. As a final thing, I think I just want to highlight what several have alluded to already before, is that what is significant about this process, I think, is that it tries to cover some part of tax problems that are there in a multilateral way as opposed to a bilateral way, and I think that is quite significant. The outcome or the calculation for countries involved might be quite different from the bilateral scenario, which makes things more complex, but I think also brings about quite a number of opportunities in order to come to something that can be both fairer for weaker parties in the negotiation, and that can also be attractive for a variety of stakeholders.
Thank you so much for all of our speakers. Thank you, Frederick, Everline, Faith, and special thanks to Lieselot, who is leading the Workstream 2 discussions. We really appreciate all of the efforts that you're doing. And it has been a great discussion with you, going through some of the technical aspects of the design of Protocol 1. It's true that there are still some challenges or clarifications that are being made, but these kind of discussions and challenges are the ones that at the end of the day create the solution, such as Protocol 1. So we are looking forward with optimism towards how the final design of this protocol would look like, and hopefully we can, all of us follow these discussions in the future. And so thank you so much. The discussion is going to be available online, and hopefully we see you in the next webinar. And special thanks also for all of those that attended and are following the discussion online with us, the audience. Thank you so much. And I'm going to wish you a very, very good day. Thank you so much, and see you soon, hopefully. Bye.